So we start off with the biggest fundamental change this week regarding rough storage. So we've seen Centrica announce changes to the operational capacity for winter 16. Initially we thought there was only going to be around 10 wells operational during winter at a best case, and what's happened is Centrica have come out and stated that actually they think there's going to be as much as 20 wells available from the 1st of November. What that's done is act to increase supply security for the UK during the winter season, and particularly for Q1, and that's acted to really suppress prices early this week. Sticking with gas fundamentals, if we look at UK continental shelf, over recent weeks we've seen a lot of maintenance there, and a lot of it's come to the end over the weekend and start of this week. That combined with higher Langlead flows have seen gas supplies to the UK increase and facilitated an oversupply market, which again has provided some downward incentive to prices. Looking at the power market now, it's a bit of a mixed bag. If we look at wind generation, it's expected to be muted for the rest of this week, down at kind of half a gigawatt. However, that's going to be mitigated by the return in nuclear capacity linked to Dungeness B22, which resynced with the grid over the weekend and is expected to gradually increase output throughout the start of this week. And that should mitigate the offset some of the losses of wind generation we've seen. Finally, looking at the oil market, if we start off looking at the US dollar, that's in a big update at the start of the week, and that's acted to suppress oil prices, pushing them back below $50 a barrel. On top of that, speculation around the potential OPEC production freeze, that started to ease off a little bit and again has facilitated lower oil prices. We start off looking at oil prices. As we mentioned, they've fallen back below $50 a barrel, and that's been driven by a stronger US dollar as well as easing speculation around a possible OPEC production freeze. Now, the lower oil prices themselves have driven some downward incentive on UK gas and power seasonal contracts, but by no means the main driver has been rough storage, and this is the announcement from Centrica regarding its operating capacity for the winter. This has driven sizable losses on the front season for gas and power, as well as driving sentimental losses further out on the curve. Looking at contracts closer to delivery, the fundamental changes we've just spoken about, so the increased UK continental shelf production, as well as the return in nuclear generation, that increase in supply in both gas and power is expected to see contracts close to delivery potentially trade a bit lower this week. So customers looking to place a fixed price contract should treat this recent downturn in the market as a golden opportunity to enter the market and fix out those contracts. Whilst there's still opportunity linked to this rough storage announcement, there is still an awful lot of risk for the winter season, so the sooner you can get in and fix that contract, the better. Getting across the line as quickly as you can is going to potentially mitigate some of the upside risk going forward. For customers with flexible contracts, this downturn in prices is essentially the start of a new downtrend, and you need to make sure that your hedge positions reflect that, whether that means unlocking or continuing to hold on a lower hedge level, just making sure that if there is a significant downturn in prices, you're best placed to benefit from that downturn in prices.